this is as far as markets are concerned. Let's get on with our management conversations. And well, right at the top, we have with us Manish Gangwal. He's the Chief Financial Officer at Gulf Oil Lubricants India, who joins us on the show. Well, Manish, good afternoon, and thank you so much for joining in. Well, I want to start by asking about the company making significant acquisitions in the EV-related businesses, and I want your view and your way forward as to how things could potentially pan out for the business is in this area specifically.
Yeah, good morning. Thanks for having me on your show. Basically, as a lubricant company, we are primarily a lubricant company, and we have been, servicing our entire range of automotive and industrial lubricants for last many decades in India. But EVs started becoming sort of talk of the town, and more people will be looking at EV as an option going forward. While we believe that lubricants market is going to continue to grow in India for many decades still, but we as a company, wanted to look into the EV value chain and where we can play as our role in the EV value chain. And what we figured out was that we have a very strong brand which is known to the automotive consumers. Today they may be an ICE vehicle consumer, tomorrow they may be an EV consumers or EV buyers. How to remain relevant to those consumers, those buyers. At the same time, we have a very strong connect with OEMs who are doing currently, let's say, ICE vehicles, and tomorrow they may venture into some sort of EV models they may bring out. So how to use those strengths and our distribution network. With that thought process, we started looking at the sector, and what we came through was that manufacturing of chargers is a good opportunity. And as the EVs grow, there will be a requirement of more and more chargers for EVs. And that's where we started acquiring companies. We acquired a company called Indra Technology in UK, and their expertise is slow chargers, slow AC home chargers for cars. And then we acquired another company in called Tyrex Transmission, based out of Ahmedabad. They are having DC fast charger products. So we have now complete end-to-end charger solutions for any of our consumers, buyers, customers, OEMs. So right from AC chargers to fast DC chargers, we have a complete range.
Right. Manish, at least as far as Tyrex is concerned, we understand that you had strong revenue growth in the second quarter. Even your other acquisition, taken together, can you give us an idea about kind of contribution that these companies can bring forward to your consolidated numbers, if not for the next 6 months, for perhaps the next 18 months?
See, our objective in Tyrex, particularly where we have 51% stake and they are fast growing. When we acquired this company in October 23, their last reported FY23 turnover was 12 crore rupees. So on a very small base, then we doubled it in FY24 to nearly 25 crore rupees. And as you rightly mentioned, in H1 itself, Tyrex has delivered 25 crore so growing at nearly 300% over H1 last year. So this company, overall, the demand is very good. And we believe that the company can at least double the turnover every year for the next 3, 4, 5 years. And should be easily doable, which means that we are aiming at roughly 500 crore rupees at least turnover in next 3 to 4 years from this acquisition.
And when it comes to profitability for both these companies, Manish, what's the way forward? When can we expect them to be in the black?
So currently, they are EBITDA neutral at this stage. What we are also doing is that the company is investing into R&D. Company is investing into a lot of service network required for servicing those chargers and installations and all those capacities, plus strengthening the manpower. We are expanding the capacity of the plant now. So there is a lot of investment which will be there in these building the company into a very, very formidable company, a very strong player in the market. But we believe that once we reach a size and turnover scale, the company should be able to deliver at least 12 to 15% EBITDA margins, which is what the lubricant business is doing. So it will not be a margin dilutive business on the consolidated basis for the company.
Right. Well, moving on, let's talk about your core business. And at the moment, what can you tell us about growth expectations going forward? Keeping in mind how your first half of this financial year has been for you, what can we expect in the second half?
So we had a very good first half, I can say. Growing our revenues nearly around 8%, growing our EBITDA by 15% and PAT by 20% plus. So we had a very good H1. Typically, the lubricant season starts in from October onwards. So H2 is usually better than H1, as that's the past trend suggests. So we are hoping for a good H2. Also, I would like to add that some of our segments like factory fill business, where commercial vehicle is our primary segment for factory fill, they have not been doing lifting that much from OEM perspective. As we know, commercial vehicle production has slightly gone down. So if we foresee that commercial vehicle will also be now lifting more and H2 will be better for them, that should also add up. So overall, we are looking for a good H2 and while delivering an excellent H1, I would say.
All right. What I also want to talk about specifically about AdBlue, and in this case, if you can give us an idea about the kind of traction that you're witnessing here, the kind of market share that this particular product has right now, and what can you tell us about the outlook here?
So AdBlue as a category, as you know, is mandatory now for all BS6 vehicles, diesel vehicles, and it's been rapidly expanding in terms of requirement. We have nearly made our volumes 6 times in last 2 years. So our FY22 volume was around 16,000 KL, and then we did 78,000 KL in FY23 and nearly 128,000 KL in FY24. So we have nearly grown more than 6 times in last 2 years. So that is a massive, I would say, expansion. But and obviously, as you mentioned, we have close to 25% market share here. But we believe that this category will continue to grow now. Double-digit 15-20% growth annually is what we are expecting in this category. This is a relatively, high volume, low margin business, but in the end, it is need of the consumer, need of the customer, which is already buying our lubricant. So, and synergistic to our distribution, and that's why we have gone ahead with the approach of delivering a value product and a very good quality product to our customers. We are quite hopeful that AdBlue will continue to grow at least 15% for the many years from now on.
Right, Manish, a question also on your overall operating margins. Now, we've seen some amount of volatility in your key inputs, and the question really is that, firstly, how much of that volatility in the key inputs comes in the ongoing quarter, or is there a delay? And based on that, what is your overall projection on your consolidated operating margins for this financial year?
So we have been guiding a band of 12 to 14% EBITDA margin, and we are quite hopeful that we have delivered it in H1. We are quite hopeful it will be, even slightly better than H1 in H2. Also, we have seen that crude has sort of stabilized around $72, $73, below $75, and if that remains, typically the lag effect of that is on the base oil with 1 to 2 months of time lag, and we believe. So far, we have not seen any major impact on base oil, but we are quite hopeful by Q4. If there is some improvement in base oil pricing and the market price competition scenario remains stable, we should see positivity in the margin. But we are sticking to our guidance of 12 to 14% margin band for H2 as well, while investing more in our A&P. As you must have seen, we have a mega campaign going on right now, which started in September, the Unstoppables, where all our 3 brand ambassadors, MS Dhoni, Hardik Pandya, and Smriti Mandhana, have come together for the first time. So it's a mega campaign, on ground, off ground, in movies. There is a lot of activity going on, so we are spending slightly more on A&P as well.
All right, and a final question then, Manish. Going forward, at least as far as your second half of this financial year is concerned, are you going to look to consolidate on your current product line, or are there going to be newer introductions here as well in store?
We keep introducing new products. Right now, as a part of our Unlock 2.0 theme, which we unveiled sometimes in June, we are focusing internally on premiumization, which means the high margin products, synthetic products. More and more of those will be part of our portfolio and sales efforts, and that's where we see new products being launched quite regularly in requirement with the market needs.
All right, Manish, we leave it at that. Thank you so much for joining us and taking us through your views on, well, the company, of course, as well as the, outlook going forward. We wish you the best. That's the management of Gulf Oil telling us about, what's in store, the plans on the anvil, and also, of course, we've discussed plenty in terms of this performance. The stock itself has, as well as done reasonably well because it's up as much as 58%, as you can see on your screen there, in the last 12 months. So certainly an outperformance, if I can call it that, even with respect to your key indices coming through. But with that, we shift focus to yet another company which has in fact also outperformed the key benchmarks, and that is NCC.